Great. Good evening, everybody, and welcome to IIFL Wealth TV. Have a very distinguished panel of experts today to discuss what happened in the budget. Of course, the big thing was long-term capital gains tax introduction. But before that, let's take a very quick introduction of the people on the dais. So first is Mr. Jairaj Purandare, Chairman of JMP Advisors. All of you have been sent the detailed profile, so I'll not go into details of each person. Then to my left is Mr. Bharat Shah, who is the Executive Director of ASK Group. Then is Girish Vanvari, Head of Tax in India for KPMG. And then Ritesh Jain, who's the CIO for BNP Paribas Mutual Fund. So we've got a mix of market and tax experts. So before we delve into what happened today, let's first take a quick view of or a quick take of the budget from all the experts, starting from Ritesh.
Okay, good evening to you all. I think the backdrop of the budget is very important over here because for the first time I'm seeing after a couple of years that the Indian economy actually was recovering even before this budget. And what this budget has actually done is, as you all know, that most of the things were actually focused on rural areas. So more money has been put in the hands of people, which is not bad from the economic point of view, but it is coming at the expense of fiscal spending, which was evident on the fixed income side, where the fixed income yield actually reached 1.5-year high of 780 on 10-year bond. So bond yields have actually risen 140 basis points in the last 6 months or so. But clearly, an economy which is already recovering is going to be more and more money being put into the economy on top of 7.5% GDP. So I will not be surprised to see that the economy surpasses the expectation of Government of India itself, and possibly we touch near the 8% on GDP growth rate, coupled with almost a 5% inflation. Almost a 13% nominal GDP is very good for corporate profitability, but it is not so good for on the fixed income side.
Great. Bharat bhai, your views?
Well, I'll say three things that one was watching before even the budget got presented. A, what is going to happen on the fiscal deficit front, whether we'll rein in the number at what was targeted at 3.2, and that would have meant probably affecting the capacity of the economy to expand if we would have held it very tightly, given the special situation. Second, what was anticipated, whether there is any movement towards income tax rate cut, and thirdly, clearly from a market perspective, whether long-term tax is going to be brought about or not. On the very first one, if you look at the fiscal deficit for the current year, that is 17-18, which was originally planned at 5.45 trillion, has been revised to about 5.95 trillion. But if you look at the composition, all the income, the corporate income tax, as well as individual income tax, all collections have been in order. Expenditure also, by and large, has been held to what were the amounts targeted. One major change in the cost or the expense has been what has been called tax administration, which is nothing but amount paid out to the states on account of the GST transition, which was in the 16-17, the transfer was 12,000 crores, which has moved to 77,000 crore in 17-18. That 65,000 crore really is and it is budgeted at about 1.05 trillion for 18-19. This amount essentially was held out to ensure that the GST becomes acceptable to the states and they come on the board. So I don't see this as a really any difficulty. Actually, I think if this is what is going to bring about GST and eventually it will transmute into the benefit to the economy, this is a good thing. So I'm not so much worried about the fiscal deficit number. As far as income tax is concerned, I think given the fact of the fiscal deficit number to be held, obviously it would have been difficult in the current year to initiate any tax cuts. So there have been those relatively at a lower end tax cuts which have been made. As far as long-term capital gains tax is concerned, I think behavior of the people has invited it upon themselves, because it was abused very badly, and to that extent it became kind of inevitable that something like this were to happen. But the fact that they grandfathered the existing capital gains was definitely very, very thoughtful. Otherwise it would definitely would have affected the market. So if on a longer term basis, if it encourages more long term behavior, not just 1 year but much more beyond that, and if at the end of it one has to pay about 10% tax, I don't really frown upon it. Yeah. I think that's fine.
So let's be on that topic of long-term capital gains. So we'll just bring in our tax experts. Girish, we'll start with you.
So I agree with you. Long-term capital gains tax has come in. It's a reality. And clearly there are two silver linings, the way I see it. First of all, grandfathering has happened. So up to 31st January, the cost has been grandfathered. It's been taken up. And second is the rate is also 10%, it's not 20%. So somebody just called me and said, okay, now will people take out money from the stock market? Okay, so I asked him, so where will you put? FDs, tax rate is 30%, property, rental is 30%. So clearly 10% still gives a good call to other sources of earning money. However, I mean, go to the devil in the detail. Devil in the detail is like, what happens for the past? So I'm an entrepreneur, I've set up my own company. I didn't pay STT when I acquired the shares, and now when I sell it, I pay STT. Will I get this benefit? Answer is, I have not paid STT when I acquired the shares. I'm an employee, I got stock options, and what happens to those shares? I haven't paid STT when I got those shares. I've got shares in a merger, I got shares in a demerger, I got shares, pursuant to bonuses, I got shares in any other form which I can think about. What happens to those kind of situations? Now, fortunately, the law says that they will come up with a circular to deal with these kind of situations, but I hope the anomalies get covered sooner. Somebody called and told me that, oh, does it mean that, we should sell off the shares? And clearly, for the next 2 months, if you see, if any appreciation happens, suppose the market goes up 10%, if a stock goes up 10%, you sold the shares, that 10% appreciation also will be tax-free. You can always re-enter it. Okay, yes, you can say the date will get reset on long-term capital gains tax to short-term capital gains tax. But clearly, I mean, if I look at the budget this time, I'll play a taxman role here. Fiscal deficit, yes, I mean, if you look at the overall perspective of higher GST registrations, demonetization, increase in tax base, I mean, it's looking good. And long-term capital gains was on the anvil, but it has been brought in with a lot of checks and balances. The last question on long-term before you move ahead is that, does it put foreigners better off than Indians? Answer is yes, because if you were a fund overseas, if you were an FI, FPI, which has grandfathered shares from April 1, 2017, you can sell it whenever you want. Even the upside is tax-free. So like, let's say if I had shares in some companies and I sell it in say 2019, even upside from 18 to 19 is tax-free. But for an individual, the upside is capped to 2018. So clearly,
so can you explain that in a bit? So
I'll give you an example. Take a FI, FPI, which or a private equity or somebody from overseas which was owning shares prior to April 1, 2017 in any Indian company. For them, whenever they sell that share, it's going to be tax-free because the treaty grandfathers it.
But I believe the treaty was changed in Mauritius to...
but the grandfathering happened. So whatever they held prior to April 1, 2017 is exempt. So for example, if they had today a share in a company worth 100 rupees, if the price becomes 400 after 3 years, their 300 also will be tax-free. But as far as I'm concerned, 400 minus 100 will be liable to tax. So they are better off to that extent, and that's a parity.
But it would definitely impact new investors coming in, new FIs coming in. They get taxed.
Absolutely. Yeah. I would say that there are some treaties which are still valid. So if you look at, say, Netherlands, if you look at some of the European jurisdiction, they still have a capital gains tax exemption for below 10% shareholding.
Right.
But individuals will have to pay taxes.
True. I think in the press there's already been articles about Netherlands,
correct,
which have come in and some papers which I was reading. Sir, your thoughts on?
So before I dive into the capital gains thing, just at a more macro level on the budget, I do believe it's a very forward-looking budget.
Okay.
I think what this government is trying to do is really address the issues of the common man. Now, obviously, depending on where you're sitting, it matters how the budget impacts you. But if the implementation of all this even goes 60-70% of the way, I think a lot is going to be achieved in terms of agriculture sector, food processing, infrastructure, education. So there's a lot happening there. I agree that it's going to, economic survey already indicated growth, and this is going to lead to high growth, I sense. It is a growth oriented budget, which also means potentially is going to give you more inflation than what we've seen in the last few years. So I think we have to be ready for that. At the same time, I think there are some really good things in the budget. I mean, when you focus on infrastructure, the sort of spends that the finance minister has talked about actually is quite humongous. And when you start looking at those numbers, one starts thinking, where is he going to get all these revenues from? Because the slippage on the fiscal deficit front is not that significant. So presumably one believes that disinvestment will be higher than the 80,000 that he's projected for next year. Tax collections will be much more. So I suspect that some of this is going to take him to the fiscal deficit numbers that he's projecting, because he's slipped on the FRBM Act, but that's okay in the sense that this is a direction the country is taking. If I were to come to the tax situation, you know, I agree with what Girish has said, and there are situations where FIIs or foreigners will end up paying tax, except for certain treaty countries where they will still be exempt. Treaties haven't been changed as yet, and there are countries like France or Ireland or Netherlands, etc., where you can potentially get the benefit of not having tax. But India is out there to actually go out and renegotiate these treaties. So some of the changes that have been made actually are going to give the basis for India to renegotiate those treaties. And as some of you will be aware, there is the whole OECD BEPS project going on, and the multilateral instrument which has been signed by India. Soon it will get signed by others, and potentially what's going to happen is that the treaties will be overridden by what is in the MLI. And that MLI may or may not, depending on what you're signing with which country, give you a benefit for capital gains or may not give you a benefit. But I think the great thing is that it's been grandfathered, which is, I think, excellent in terms of making sure that the amendment is prospective and not retroactive, which I think is very creditable and noteworthy. I'm happy about that, because otherwise it would have created a huge issue. I think apart from capital gains, there are of course several other tax issues which we'll come to in the course of our discussion.
Sure. There's one question which many of our investors have asked after the budget has come in. So let's assume the share price of a particular share on 31st January is say 120 rupees, and you sell it say somewhere in 2019. Let's not give a date. So it's definitely long term. And the price at that time is 100 rupees. Now, does that mean that you get a long-term loss?
So I'll put one more rider to your question. Let's say I've acquired the shares for 80 rupees.
Right.
And today the price is 120 and I sell it for 100.
Yeah.
Then is the loss 20 or 40? And the section clearly reads well.
Yeah.
It says that the cost is capped up to. And which means the gain in this case, the loss in this case would be only 20. Perfect. You can't have a notional loss which you will carry.
That's right.
Perfect. And this loss obviously can be offset against any long-term.
There are no change in rules in that respect.
Perfect.
8 years.
Perfect. Great. Now let's quickly come back on the fiscal discussion which we were having. So Ritesh, we would like, because you've been a stalwart in the bond markets, how did you read the fiscal situation? And let's only put your bond hat today for this question and not the macro hat for a minute.
So for me, a fiscal situation is if there is enough demand for bonds in the market, there's no reason for bond yields to rise. The issue is that the marginal buyer of bonds are not there in the market. Mutual funds used to be big buyers. Banks used to be big buyers. But after demonetization, deposit growth rate actually came down to almost nil, 2-3%. And with the rising yields, even the money of mutual funds is actually, mutual funds are losing money rather than getting money at this point of time. And on the top of that, we have a central banker who has very clearly stated that banks should be looking at the risk management closely and should not be depending upon Reserve Bank of India for managing their losses. So in this kind of environment, and there is one more thing I must talk over here, is globally central bankers are actually withdrawing from the monetary policy. So they are tightening their monetary policy, which is getting complemented by the fiscal policy. Same thing you are finding it in India. All these things when I put together, I find that all of this thing is actually will lead to higher bond yields. Now, how much of it is already in the price? Market is already discounting the rise in 2 rate hikes from the RBI. Having said that thing, I will not be surprised to see 10-year bond between 8 to 8.5% by second half of the year. Honestly, around at that point of time, deposit growth rate in the system or the deposit rates, I will not be surprised to see 100 basis point higher deposit rates in the current level. At that point of time, money can start moving back to bank deposits, which it was not there for last 1.5 years. And at that point of time, possibly would be enough demand of bonds because the yields will be too attractive. But at this point of time, I'm very clear in my mind that over the next few months, although a lot of damage has happened to the government bond yield, still there is scope for bond yields to rise by another 50 to 70 basis points from the current levels.
Great. Let's go back to taxation, the foreign point which you mentioned. Now, the Singapore and Mauritius Treaty talk only about shares, now, which probably means that if a foreign investor comes into a domestic mutual fund and sells stocks after a year, he still is tax-free. Is that understanding correct?
Absolutely right. It's only shares, bonds are not covered, debentures are not covered, CCDs are not covered.
So which means that our local mutual funds now have a huge market open to go and target.
That's right. Absolutely right.
Great. Any other tax issues both of you would want to highlight to our viewers?
So there's one thing I would want to point out, which is what the finance minister said a few years ago. And he promised everybody that in 4 years, the rate of corporate tax is going to drop. And it's going to drop from 30% to 25%.
Yeah.
What he's done in the last few years, and this year he's made a further proposed amendment, is that certain smaller companies will be taxed at the rate of 25%. But what has also happened is, effectively for larger companies, the rate remains at 30%, and the surcharge has now gone up to 4%. So instead of the rate dropping, you have actually got an increase in the rate by maybe 1/3%.
Yeah.
But it's still an increase. So it's actually opposite to the direction that was promised a few years ago. Similarly, if you look at what's happening, and he said 99% of the companies will have, will get the benefit of the 25% rate because their turnover will be less than 250 crores. So most companies will effectively pay tax at a rate of 25%. But you have an LLP, for example, paying tax at the rate of 30%. So it doesn't quite make sense to operate as an LLP, subject to other business considerations, but just purely from a tax rate perspective. That's one big sort of change, I think, which people need to take note of. Girish.
No, I would agree with you, and Jain, that lies an opportunity also. That can you be below 250? Are you below 250 last year? Should you do expansions in companies which you have in the group which are below 250, so that till they reach 250 you have an exemption? And Jay, I mean, I was seeing some post-press government conferences which actually said that they want to corporatize India. So they actually want LLPs to become companies, and
which makes sense.
That's why they want to. So maybe it's intentional, Jay. That's why they are moving in that direction.
So it doesn't make sense to operate as an LLP anymore. You should corporatize.
Absolutely. And if you look at the overall sentiment at large, with this 30 becoming 25 for 99% companies, which is 7 lakhs into 99%, it is creating a positive sentiment in the places where GST is anyway turning out to be a burden. They're not trying to woo the 1%, 7,000 companies, and they want to make the smaller companies happier.
So now, if we want to translate this into the markets, how much do you think this affects, say, what percentage of number of companies does it affect from a 250 crore turnover, and how much does the EPS impact happen on companies?
Listed segment of the market, companies with less than 250 crore turnover is not really meaningfully large, or at least the segment which is investable from a perspective of an investor is not meaningfully large. So I don't think anything changes as far as investors in the market is concerned to see whether there is any meaningful reduction of the tax liability of the investee firms, because even if you essentially you are saying companies which probably will less than 250 crore is unlikely to make more than 35 to 40 crore of operating profit, and which means probably not more than 27 crore of post-tax profits.
Correct.
So those kind of companies are very small in India.
Right. Very, very nano cap kind of.
It's very
Possibly in mutual fund there are that is not even a part of an investable universe.
Yeah.
Correct.
So you don't go below. Normally, some mutual fund will not go below 1,000 crore. And the kind of money mutual funds have got,
Yeah.
it doesn't make sense
Just
to
doesn't make
go down
sense.
to and have one more car.
But I just have one observation for both of you gentlemen, and this is the query I got from somebody who had 8 subsidiaries. So, many companies operate in JV structures, subsidiary structures. So at the top level, they may be 4,000 crores, but they may have businesses in less than 150, 200 crores, especially in financial service sectors. And when you aggregate the taxes, there may be some upside. I don't say it's a sample universe, but it's
from
an investing perspective, it probably
But
does
you look
not
at the
matter.
consolidated tax, so
But
you may
I'm
just see
sure,
some upside somewhere.
In my
I don't
opinion,
know.
I am sure they'll take into account.
Yeah.
This can be a route through which you split number of companies.
No,
and
no.
create-
No,
And with GAR and
I
all,
don't
no
think
way.
that's a.
Yeah,
with
and
GAR
also
all,
Girish-
no way. I don't think that should be.
Girish, from a
used for tax
market
money.
perspective, there's something called a holding company discount. which
Absolutely.
is-
Correct.
so it
Automatically,
really- So
From
just
a GAR,
to save,
we can't do also.
yeah, just to save some tax, you're
You'll not be
possibly
able to
going
do
to
that.
disrupt
You'll not get
market
the
cap.
value.
Yeah.
But I wanted to make a point. I mean, if we look at the kind of projections for the next year,
Yeah.
it very clearly indicates that economy, at least in my opinion, economy is already moved up. Economists typically will disagree, and probably they'll agree after 3 or 4 quarters. But economy has already moved up, in my opinion, and there are lots of telltale signs that economy has improved. Your commercial vehicle sales, your car sales, your two-wheeler sales, air traffic, hotel occupancy, even the loan growth for the first time turned into double-digit recently. Many other indicators suggest that there is a change. I mean, if you look at the consumer firms, most of them have reported 11, 12, 14% volume growth, not just the top line growth. And if you look at the projections, your income tax is projected next year to grow by 20%. Corporate takes it about 11%. So collectively, direct takes it upwards of 15%. So roughly, let's say it's 7.5%, or if Ritesh is right, at 8% GDP, then we are talking of 2 times the tax buoyancy in number as far as direct tax is concerned. And as far as indirect tax is concerned, the projection is about 19% growth, which definitely implies that the GST filtering effect would, by and large, will get settled in the next year, and the upward trend would begin. In my opinion, these are some very significant indicators of what is in offing for the corporate performance.
Perfect. Ritesh, now we'll just, BNP Paribas Mutual Fund also advises, large part of the offshore money. Now, when you wear a hat of a FPI advisor or somebody who represents a large global group, how do you see this tax change of 10% long-term capital?
I think I've had a deep discussion internally as far as the local mutual funds is concerned, because these days local investors are the ones which are flocking our funds more than the FPIs at this point of time. I think they have found better revenues, or maybe the other markets have become more interesting. So if I could talk from the local investor point of view. So except for one particular category, which was the arbitrage fund, which has been gaining a lot of prominence over the last few months, possibly after the interest rates have also moved out. That is the only category where we believe that there could be some kind of tax incidence, or possibly some kind of flows which can slow down. Otherwise, I do not think a 10% tax on the long term is going to make investors shift from any other asset class, from equities to any other asset class, simply because there is no other asset class which is as attractive as equities at this point of time. Possibly a year down the line, if the interest rates rises by whatever I expect at this point of time, the money can move internally from equity to fixed income. So only the arbitrage category is the one which become less, interesting or less exciting at this point of time.
Perfect. So I just want to move to one hot topic which has been all across news sections. the creation of jobs, and there was something which the government mentioned that they would pay 12% of the first time PF entrants for the first 3 years. Now, Bharat bhai, any thoughts on how deeply will this impact the job market?
Well, I think government is trying sincerely. Overall job situation, there are enough macro background factors which militate against job creation. I mean,
no. So actually, I'm trying to gauge whether this was an effective solution or not. So will you, as a corporate, just because the government's paying 12% provident fund, be incentivized to hire more?
In labor-intensive businesses, yes. For example, textiles, I would assume that, which is a very manpower-intensive activity, typical salary wages paid to the per worker level are about 9,500-10,000 rupees. It's a significant amount if that kind of a benefit is extended for 3 years. So, there is always people have been in absence of liberty to fire labor. There has been a tendency to substitute labor by the machinery and the robotics and what have you. And to that extent, it militates against the long-term interests of the labor itself when they oppose any labor reforms. So to that extent, these challenges and the cross currents keep going on. But 12% of a cost is not a meaningfully low amount. In my opinion, it's a significant
It's a material amount, I think.
And in labor-intensive industry, there are plenty of them which have to be purposely be identified and supported through that process. But it's meaningful amount, and it should encourage.
Any thoughts on this?
Well, I personally feel that I think it's a very good move.
Yeah.
It will certainly encourage employment. Does it mean that it's suddenly going to take employment numbers through the roof? No. Right. But I think it's a good incentive. It's a material incentive to give to employers to incentivize them.
And if you see the data, number of new PF registrations has been up last year by almost about 71 lakh.
Correct.
So there is that number. Some of it could be because some units which were below 20 number of people employed, and when it gets into 20 plus, then all of the employees come into the PF stream. So there could be some additional impact of that kind, but still it is a significant number which has increased. And this is in the formal area. And the vast arena of employment is actually informal. And if Mudra loan is anything to go by, the target for the next year is almost 300,000 crores. At that rate, Mudra becomes one of the top banks of the country actually. And if you're saying that almost 10.2 crore accounts have been funded by Mudra, and if somebody is doing something to either self-employ and gainfully employ somebody, I suppose what government can do, it is doing, I would say. Overall challenge of finding jobs remains.
Sir,
I have two tax points to make on what you said.
Yeah.
And these tax points are the two threads which I see in tax which support what you said. First is the startup concession. The startup concession has been broad-based. So first it was only for innovation, now it's for anything which creates jobs. And if you go to the government, get an approval, anything that creates jobs gives you a concession. And the period has also gone up.
To 5 years.
The period is 5 years, very enabling. The sunset date is also 2021.
So it's extended by another 2 years.
On employment. And you know that, I love that clause which said that anything which creates jobs, it's actually there in the section itself. Second thread, you see the MSME concessions. I mean, if you put the threads on MSME, the NPA cleanup in MSMEs and the earmarcation of funds for MSME, it all plays out. The intent is, if you put all of them together, they want to create jobs in small ways, but yes, it is there.
I'm just to clarify what he said is threads and not threats.
Yeah.
So I will not be so optimistic. There are 1.2 million graduates which are entering the workforce every month.
Yeah.
Obviously, we are touting about this PF, the number of additions. But clearly the world is moving to capital light models. It's no more capital heavy models. If you're going to capital light models where clearly technology is taking the front seat, we do not have a skilled workforce. By just giving an incentive to hire more people is not going to work. We are just delaying the problem. The problem is of the unemployment. And I don't think this is going to materially change any of the things.
But Ritesh, that problem is a larger problem. In the world of artificial intelligence and robotics and quantum
I think that's a problem which is a huge problem for the government.
Sir, I don't think this is a problem which is there for the developed economy. I don't think this is a problem even for China for the first time. That one-child policy they instituted 30 years back. Today, actually, that economy, that thing is helping them.
To them.
The consumption economy is moving. Correct. The problem is ours.
But we are India and not China. So
the technology moved on.
I think what Ritesh is trying to say is that the demographic dividend which we've always been talking about could.
It's turning into a demographic challenge in my view.
It could, especially when you cannot provide education and employment to your people, then those same people are going to have a real, I mean, you don't know what they will be doing in life.
True.
If they don't have a job.
Of course, we can always have the debate on this topic, dedicated maybe sometime else. But I'll quickly move to something else which I saw on the real estate side. Right? Now, there has been some relaxation on the circle rate or ready reckoner rate up to 5%. Now, does that 5% really help? Because there's so much of a difference when I look at, say, properties in Lower Parel or even some parts in Delhi. The circle rates are maybe 50% higher than what actual market rates are. So, did it really solve that problem?
In my view, no, because you're right. Ready reckoner rates or circle rates are usually much higher. So, it's only going to help those where there's a marginal difference of 5% where you stick to your sale consideration. But in most situations where it is high, I believe it's only a marginal benefit. It's not really going to benefit a lot of people.
I agree because that difference is more, not everywhere, but in quite a few circles it is much more. That is for a simple reason that the circle rates had were like a mechanical process, were rising by 6, 7, 8% every year, like a inflationary adjustment or whatever, while reality of the market prices did not catch up for a length of time, and therefore the gap has widened.
Great. And maybe one last comment before we open up for Q&A. Any thoughts on the biggest health insurance coverage ever given on this planet?
So some people are already comparing it to Obamacare, but I have done some numbers, 10 crore people. What they've provided for is 4,000 crore. So 10 crore people, if you say there's a 50 crore people basically, means 10 crore individuals and a 50 crore people, a family of 5, a 5 lakh rupees of floating insurance will not cost you worse come worse on a less than a 10,000 rupees. That roughly means 1,20,000 crore of the hit they should have taken or provision they should have made. The amount of provision which has been made is 4,000 crore. Now we can always say, it is just a start, 10 lakh people will be there, over a period of next 5 years it will be 10 crore. But the way it was announced and the number which has been provided are completely way off.
True.
If it is implemented, there's nothing better than that. But where is the money?
Yeah, of course, baby steps in the right direction. So right now we open up for Q&A. Okay, so we have some questions which have come. I'm just reading on the screen. Whether LTCG introduction affects the market growth long term. So Bharat
Well, if the impact is perceived to be negative, I don't think so. As I said in the opening remark, the introduction of long-term capital gains tax in some sense has been brought about by people themselves by abusing what was genuinely a very liberal concession offered to the investing community. But it has been abused very badly, and we all are aware that there have been significant leakages which have been created over a period of time. And therefore, government can't allow such abuse going on for such a long period of time. Whether that affects really the course of the market, I don't think so. Long-term capital gains tax existed even before it became zero. So it is not as if long-term capital gains tax wasn't there earlier. So I I for one will not really worry about this. My worry would have been very high if grandfathering of the capital gains was not kind of ring fence. Since that has been taken place, I think it's a new game and new match, and people will take into account the cost.
So if I may add a comment here, I personally don't feel that it's going to really have any impact on the market. I really don't comment on the market, but I think here the finance minister has taken a calculated gamble. It's a calculated risk. If there are 6,000-7,000 crore rupees coming in through SIPs, etc., every month into the capital market, whether it is mutual funds or shares, etc., where is this money going to go if they doesn't go into the capital market? Today, I think the choices are extremely limited in terms of gold, in terms of real estate, with the real estate market being what it is. So I think he's taken a calculated gamble that people are still going to invest in the capital markets, in the equity mutual funds, and they're willing, and they should be willing to pay a 10% cost to it, and he's made it prospective. So I think, and when I was listening to the budget speech, I saw the Sensex fall by 400-500 points. When the grandfathering was understood, then it sort of creeped back up. So I suspect it's not going to have any material effect.
And I'll just add one technical point. First of all, 10% to my mind is a fair kind of a number. It's not unreasonable. But if the long-term capital gains are enjoyed over a prolonged period instead of just 1 year, let us say the gains are extending over 3 and 4 years and then booked, then taking into account the time value of money, the real effect of that 10% is further reduced. So to that extent, it's a fair, reasonable rate.
Right. So the next question is, how will FDI investors react?
I would say FDI investors are normally long-term investors. So FDI investors come into mostly unlisted companies, and their exits not necessarily is an IPO or a sale on the stock market. So the India opportunity remains very good. As you said, all the FMCG companies and different kinds of opportunities are there from a longer-term perspective. I don't think FDI investors will have a reaction to this because they are long-term investors. IRRs are not so critical upon this 10% rate. FPIs, FII is the normal market investor, which is the public market platform, the ball funds, which answer you've already given.
So from an FDI perspective, my belief clearly is that it's not going to impact. Nobody invests just because there's a 10% tax that's going to have an implication. Perfect. They may well get the benefit of a tax credit back home, possibly. And generally, if you have certainty of tax, not that there is a tax, then people don't mind. They know what it is there. And generally, tax is not the reason why somebody is going to invest in India alone. In fact, our revenue authorities have been known to be aggressive based on some things that have happened in the past. So this actually provides some degree of certainty. You know there's a hit, fine, you know what it is, you'll factor it into account, and it's a business decision that will drive FDI to come to India.
Right. So Bharat Bhai, there are two sectoral questions which we have. One is on the banking sector and the other on the cement sector. You would want to give some?
Well, I think I alluded in an indirect way in the opening discussion that we have had. I believe that the economy has already turned up, and more tangible evidence will emerge. And as Ritesh was mentioning, probably growth will surprise us on a positive side. Instead of 7.3 to 7.5, he is bullish enough to think that it may touch even 8%. So 8%, if the GDP growth rate occurs and you count inflation, that's wonderful news for banking and finance segment. Of course, the net interest margins need to be watched in terms of how the cost of borrowing will change and whether the lending yields can correspondingly match or not. But overall, I will remain extremely positive about the prospects of the quality banks as well as the quality finance firms. The other one is on the cement that you see. Cement in general is on a structural transformation phase. Industry has been consolidated into a few players. Those few players have become world class in terms of their cost and capability. So by and large, these are very, very competitive firms. The trouble has been for a length of time excess capacity available, but even utilization is now touching close to 75%. So roughly at about 85% utilization, you would be looking at a fresh kind of a capex, which is like saying that maybe a year and a little bit here and there. So given the kind of thrust on the variety of the infrastructure projects that the government has been putting, plus the growth of the economy, I think cement is on a structural long-term gain.
Perfect. So I wanted to make a comment on the banking sector. Yeah. There are two things there. One is that there is a lot of bank recapitalization going on by the government. And the finance minister actually in his speech has made a comment that he expects PSU banks to be better enabled post the recapitalization and the insolvency resolution that is currently on, and that will get resolved hopefully if things go well over the next few years. Then they will be in a position to help funding, and loans and credit will take off better. So that is one aspect. The second is there were some tax issues related to the insolvency code, and there were a lot of concerns, and the amounts involved there can be quite high. So only a couple of amendments have been made or proposed in this bill which relate to MAT and carry forward of losses in private companies if the shareholding changes and so on. But some of the amendments that were expected have not been made in the context of section 56 or in the context of a haircut being taken and then what happens to the difference and so on. So some fundamental amendments which were hope to come have not happened.
PSU banks, I'll probably beg to differ. I think there are 2 or 3 issues to be taken care of before they get into the kind of right health. First, their existing, if they need survival capital, many of the banks are in that stage where they need first the survival capital. That just brings them at par. It doesn't get them into a pink of the health. Then the banks which need some amount of, which will survive but which need growth capital, that part of the capitalization has been deferred, which when that will happen is uncertain in terms of the timeline. Also, you need to solve over a period of time the manpower issues. There are important HR issues in terms of these banks, the staffing, the caliber and the quality of the overall manpower. These issues we should not count it as very easy to be sorted out in a very short term. So I would say, depending upon bank to bank, of course the top banks like State Bank of India or probably Bank of Baroda are in a bit of a different situation, but many other banks will take a fair amount of time, I would assume, before we assume that they will start contributing to the growth run.
Great. So some questions on taxation. So long-term capital gains, can I invest, or I think he means can I set off a short-term loss against a long-term capital gain? I think that is possible in my view.
Answer is yes.
Yes. And please advise, since this is a case of conflict of interest somewhere. Okay. Is it applicable for immovable property like flat sold? So I think he's referring to a loss which he's created on the stock market long term. Can he set off against a property sold?
Answer is yes.
Yeah, right. Perfect. We'll go to the next slide.
Asset is not material.
Right.
Whether it's long term, short term.
True. What will be the impact on the pharma sector?
Well, budget directly doesn't change anything about the pharma sector. So, if the question is whether budget in particular will change anything about pharma, I won't say so.
Correct.
Possibly hospitals can be the nearest beneficiary
Yes.
people want to talk
Yeah,
about.
but that's not really pharma company, but
Yes,
more
it's,
of
if you want to put it.
healthcare. Yeah, more of healthcare rather than pharma.
Has the MAT tax been reduced for MSME?
No.
Yeah. So, Priya, we have more questions. Okay, so I think there's another question which I think we've already kind of looked at, but I'll just repeat it for the audience. So if my share value is 1,000 rupees on 31st Jan, and if I'm holding it for a long time, if I sell it for 800 rupees, would I be eligible in Feb? In Feb is the question. Would I be eligible for long-term capital loss? If you sell it in Feb, the answer is no, but if you sell in April, the answer is yes. Yeah, unless, of course, if you sell it off market and don't pay STT, you get the loss, but if you want to sell it on the exchange, you'll have to wait till April. How will long-term capital gains on bonus shares be calculated? So for bonus shares acquired before and after the 31st of January. So I assume, Girish, I can fill in for you. I think the 31st January price would be regarded, and the gains from the 31st Jan will be taxed, and it will not be considered as the price as zero. It will be considered as the price.
Hopefully the clarification will provide.
Yeah,
that's the logical.
They are saying that they will put out a circular, and hopefully that will be clear.
Yeah. What happens to the share sales done by me this year? Will the new rules apply? The answer is no. I think the same kind of questions coming again and again.
Answer is no.
So so next question is, I bought shares in 2014 at 200. Price on 31/1 is 500. I sold today at 1st February at 520. Is the taxable LTCG at rupees 20? Because you're still in this financial year, you don't have to pay tax. This is only applicable from 1st of April.
Third question is tricky. It's important.
Okay.
It's not for new companies. You have to be in existence, and
okay,
you
I'll
have to be
repeat
below 250.
so that they
I
can't,
think you should read the
they
question,
can't see the question, so I'll repeat the question. So the question is the reduced tax rate of 25% applicable to new companies set up this or in the next financial year?
Today you have to be in existence, you have to be below 250 crores.
Yeah.
No, but I would assume that cannot be the intent. Supposing a new company set up in the current year, and for a length of time, if it is less than 250 crore turnover, obviously it
No
should
problem.
be 25.
Current year, no problem.
If it has been set up already, sir, they see this financial year's turnover.
So they are looking at the turnover of financial year 16-17.
16-17.
Has to be less than 250 crores for you to be eligible for this beneficial rate.
Perfect.
Going forward from April 1.
So if it's a startup in this year, then it will.
There's a gap of 1 year to look at the turnover and
Correct.
Yeah.
So you can't manipulate the turnover.
Yes,
Yeah.
that's
You
why
can't
they've
now
done
in the
it.
next
You
10
can't do
months
it for this year. It is the
shore up
last
the
year's
turnover.
turnover.
Yeah.
You can't
The
acquire
March
for that.
17 turnover, that is important. Comment on cryptocurrency. I mean, the finance minister said it earlier, and now he said it clearly that they don't think it's legal tender. So I'm sure you will see RBI come out with things. FEMA will be, recognize that this
Banks
is not
also.
legal, etc., etc.
Right. Okay, now there's something on the elections, right? So we can't complete any call without elections. So elections expected in 2018 or 19. I think I can do the buzzer round here.
Yes.
So, sir, your thoughts?
So I think elections will be preponed, but probably around December time. It's interesting because there's a lot of debate going on recently. This government is keen to have elections between states and the center simultaneously, for whatever reasons, good, bad, ugly. The point is that it's possible. I mean, there are 8-10 state elections coming up. The parliamentary elections come up by May 19th next year. He could prepone them.
Right.
They could be all similarly timed if they feel that that's a more beneficial timing. And why not? That discretion is to some extent available to the government.
No comments to offer.
No comments.
I think I'll be watching rural economy. If rural economy is giving me a signs of, that distress is, there's the distress is behind them kind of thing.
Then it will be called.
At that point of time, it can be strategically timed.
Yeah.
Good. Okay, so maybe one more slide. Okay.
I know.
There's one more which I can just say, can LTCG be offset with LTCL? Yes, the answer is yes, but from next year. one question. I think we'll take the last question here. Given that, and that maybe Bharat Bhai, you can take it. Given that small and mid caps have already corrected 10 to 15%, do we see a reversal?
Well, I wish I had soothsayer's capability,
Right.
or crystal gazing, but so I'll not like to predict that. All I'll say is, over reasonably long-term cycles, what we have seen is typically the indices around the larger businesses have tended to do slightly better than the indices composed of the mid-sized businesses, and mid-sized indices have typically done slightly better over long run than the smaller ones. We have seen a significant inversion of that rule for a length of time, and partly that's getting rectified. How long it will continue, I cannot comment. At least on a short-term basis, I have no view and no capability to forecast.
Okay, one more interesting question here. So maybe Girish, you can take that. Foreign investors in geographies such as US, which has a DTA, will have to claim credit for 10% taxes in India. How easy or difficult is that process?
I mean, this will be a direct credit. So when you sell the shares, you will get a direct credit. Should not be a problem at all.
Should not be a problem.
And yes, the compliance of this can be horrendous, because when you are looking at repatriating the money at each point of time, since you're non-resident, you have to withhold taxes.
Great.
And your another question which came in my other direction is that this will be entitled to foreign exchange fluctuation also. Indexation is not available to you. Foreign exchange fluctuation will be it.
Correct. There's another question on LTCG on FIs, but I think we've already kind of covered the question. So I think we're done with most of the Q&A, but please feel free to contact your relationship managers. We can always go back to them and get answers for you. Thank you for joining IIFL Wealth Live TV. It was a pleasure having you, and thank you all, gentlemen, for being with us tonight. Thank you.
Thank you.
Thank you.
Thank you.